Well, discussion on agricultural credit would not be complete unless we talked a little bit about Farm Service Agency guaranteed loans. Uh, Farm Service Agency, or better known as FSA, back during the 1980s, started guaranteeing loans, which these loans would be made by commercial lenders, whether they be commercial banks or the farm credit system. And the guarantees would be up to 95%. So in other words, what the FSA is doing is saying if there's any loss in the loan, that the FSA would provide up to 95% of that loss, and they would meet that. And so the guaranteed loan process has really become one of the main areas where FSA participates in agricultural lending. Farmers and ranchers that apply for a loan with an agricultural lender, the lender then arranges for the guarantee. So in other words, the lender, for instance, a commercial bank would be the one who goes to FSA and asks for the guarantee. The FSA guarantee permits those lenders to make loans that they may not otherwise be able to make given their normal underwriting criteria. They may have certain criteria that they feel like a loan needs to meet in order for it to be funded. And if that credit doesn't have those characteristics, but it's somebody that the bank or lender would like to maintain as a customer, then they can go and ask for a guarantee. So the guarantees can also be for operating loans and for farm ownership. So in other words, you could have a case where let's say the Farm Credit Bank is making a loan for the purchase of a farm. They could also ask for a guarantee on that loan. To be eligible for a FSA guarantee, the applicant must be a U.S. citizen or a legal resident, have an acceptable credit history as determined by the lender, and have the legal capacity to incur the obligations of the loan. In other words, pretty well everybody that applies for a loan can qualify for being an FSA guarantee. They must also be unable to get a loan without the guarantee. So in other words, the lender is really having to say to the FSA is that if I do not get the guarantee, I will not make the loan. So there's the lender has to make that obligation that they would not make the loan without the guarantee. The customer cannot have caused FSA a loss by receiving debt forgiveness on more than 3 occasions, and the owner or tenant operator of a farm, it must be a family farm after the loan is closed. In other words, they're not going to be making guarantees to operations that are not considered to be a family farm. And they cannot be delinquent on any federal debt, which probably includes also taxes. The entities that can apply for this or can receive guarantees, corporations, cooperatives, joint operations, partnership, trust, and limited liability companies, and their shareholders must meet these same eligibility requirements. In other words, when you're looking at an entity that is not a sole proprietorship, but one that is made up of more than one individual, each one of the individuals have to meet the requirements. The repayment terms can vary according to the type of loan, whether it be an operating loan or whether it be for equipment or whether it be for land purchases. The guaranteed interest rate and payment terms are negotiated between the lender and the borrower. The interest rates on these loans may not exceed the rate charged to the lender's average farm customer. So in other words, what FSA is saying to the lender is that you can't charge a higher interest rate because of the perceived risk in the loan because you now have a guarantee. In addition, they're under the interest assessment program. FSA will subsidize 4% of the interest rate on loans to qualifying borrowers. Oftentimes this may be a beginning farmer loan where they're trying to get younger people involved in the agricultural industry, and the FSA can subsidize can make a guarantee, but also subsidize the interest. Now, the loans have to be adequately secured. In other words, they still have to have adequate collateral. The collateral on operating loans consists of a first lien on crops that are to be produced or livestock and equipment that is being purchased or refinanced with the loan funds. The lien can be taken on certain other collateral, real estate property, and assessment usually will be taken on income, such as that from a dairy enterprise. So collateral on farm ownership loans consist of the real estate only or a combination of real estate and chattels or personal property. So the loans that are under these guarantees have to be well secured. Now, is the lender's loan or is this a lender's loan or the bank's loan, or is it an FSA loan? The guaranteed loans are the property and responsibility of the lender. The lender has to service the loan. It's up to the lender to service the loan adequately. It's up to the lender to make sure that they do the collateral inspections. It's up to the lender to do all of the things they would do in a normal lending situation. The guarantee just says that if the loan happens to fail, then the lender suffers a loss, the FSA will reimburse the lender up to the amount of the guarantee. So it's just really nothing more than just kind of like a cosigner on a note, is to say, okay, if there's a loss here, then we'll come in and pick up part of that loss. Now, the percent of guarantee can vary a little bit. The maximum for most loans is 90%. It can go as high as 95%. But the guarantee percentage will be determined by the FSA based on the risk involved in that loan. Now, there is a secondary market for guaranteed loans, and by this, there are some lenders that will go out and that will make these loans to farmers, particularly for loans for land ownership. They will get a guarantee, and then they will take that and sell that loan. So there is a secondary market for those loans, so that the lender may be making those loans, and then they can then take and recapture part of their commitment by selling those loans into the secondary market. Now, the advantage of the secondary market is it reduces the interest rate risk to the lender, because the lender then is transferring some of the interest rate risk, particularly on a fixed rate loan and a long-term loan. It increases the liquidity as far as the lender is concerned. In other words, they're able to, they're committing funds. They can sell off part of those funds or those loan commitments and maintain their liquidity. And it increased lending and investing capabilities of the lender. As we've talked a little bit in the past, some of these banks that are in the more rural areas that may have lower loan limits, in order to service their customers, they can make these loans, and then they can turn around and then sell part of those loans back into the secondary market. It also gives a increased return on investment. The guaranteed portion of the loan in the secondary market increases the lender's overall return on investment. And each time a bank sells a guaranteed portion, it generally retains a servicing fee. In other words, I'm selling the portion of that guarantee off, but then I'm going to maintain a fee for servicing the loan. Lenders may be able to offer a producer more flexible repayment terms if they're able to go into the secondary market with the loan.